Hello, and welcome to Islamic Finances. I'm so glad you're here with us today. In this episode, we're going to explore Islamic banking together, how it actually works, what makes it different, and why it matters in today's financial world. Whether you're Muslim, non-Muslim, curious about ethical finance, or just wondering what all the buzz is about, this conversation is for you. So, grab a cup of tea, get comfortable, and let's dive in. Before we talk about Islamic banking, let's take a moment to understand how regular banks work. It's actually pretty straightforward when you break it down. Think of a traditional bank as a middleman. People like you and me deposit our savings there because we trust the bank to keep our money safe. But the bank doesn't just let that money sit in a vault, gathering dust. Instead, it takes those deposits and lends them out to other people. Folks who want to buy homes, start businesses, or maybe purchase a car. Now here's the key question. How does the bank make money from all this? The answer is simple. Interest. When the bank lends you money, it says, sure, here's the cash, but when you pay me back, you'll need to pay extra on top. That extra amount is interest. Similarly, when you deposit money with the bank, they say, thanks for trusting us with your savings. We'll pay you a little extra for keeping it here. The bank's profit is the difference between what it charges borrowers and what it pays depositors. In this system, money itself generates more money. Whether the borrower's business succeeds or fails, whether they're struggling to make ends meet or thriving, the bank still gets its guaranteed return. It's a system that works, no doubt about it. But it does raise some interesting questions. Is money itself a commodity? Are risk and reward being shared fairly? Why is it that during economic crises, borrowers often lose everything, while lenders still collect their guaranteed interest? This is exactly where Islamic banking enters the picture, and it comes with a fundamental principle that might surprise you. Interest is prohibited, not discouraged, not frowned upon, completely forbidden. Now, before you think this sounds extreme or impractical, let me explain the reasoning behind it. In Islamic finance, money isn't seen as a commodity that can grow on its own. Instead, money is viewed as a medium of exchange, a measuring tool, nothing more. Real value, according to this philosophy, is only created through effort, through trade, through actual production. In Islamic law, interest is called riba, and it's explicitly prohibited in the Quran. But why such a strong stance? Well, the concern is that interest allows someone to earn income without working, without taking any real risk, without participating in genuine economic activity. Interest-based systems can create a cycle where the rich get richer and the poor get poorer. Especially during tough economic times, the burden of interest can crush borrowers, while lenders continue to profit regardless. So what does Islamic finance propose instead? It's built on several core principles, and I want to walk you through each one because they're really fascinating. First, there's risk sharing. In Islamic finance, profit and loss should be distributed fairly between the person providing capital and the person providing effort or expertise. Nobody should expect guaranteed returns without taking on some risk. It's about being in it together. Second, there's asset backing. Every financial transaction must be linked to a real asset, service, or economic activity. You can't just trade money for more money. Speculative transactions, the kind where you're essentially gambling on price movements, are off the limits. Third, transparency is crucial. Contracts cannot contain excessive uncertainty, deception, or risk. In Islamic law, this is called gharar, and it's prohibited because it can lead to exploitation. Fourth, ethical investment matters deeply. You cannot invest in industries that Islam prohibits. Gambling, alcohol, pork products, tobacco. Beyond that, many Islamic financial institutions also avoid investing in weapons manufacturing, environmentally harmful industries, or businesses that cause social harm. It's about putting your money where your values are. These aren't just abstract principles. They shape every single product and service that Islamic banks offer. And that brings us to the really interesting part. How do these banks actually operate without charging interest? I know what you're thinking. If Islamic banks can't charge interest, how do they make money? How do they pay returns to depositors? How do they even survive? Great questions. And the answers lie in the various business models that Islamic banking has developed over centuries. Let me break these down into two main categories for you. Partnership models. The first category is partnership-based financing. And honestly, this is the heart and soul of Islamic finance, the ideal that the system aspires to. Let's talk about Mudarabah first. This is a beautiful model where one party provides the capital. We call them the Rab-ul-Mal, and the other party provides management and expertise. That's the Mudarib. Think of it like this. You give your money to someone who knows how to run a business, and they use their skills to make that money grow. Here's a real-world example. You deposit $100,000 with an Islamic bank. The bank takes your money and invests it in a Sharia-compliant business project, maybe a halal restaurant franchise or a tech startup. If the project makes a 20% profit by year's end, and your agreement says you get 70% while the bank gets 30%, then you receive $14,000 and the bank gets $6,000. Everyone wins. But, and this is crucial, if the project loses money, you lose part of your capital, and the bank loses its time and effort in managing the investment. That's fair risk distribution. Nobody gets a guaranteed return. Now, Musharakah takes this even further. This is a full partnership where all parties contribute capital and may participate in management. Profits are shared according to predetermined ratios, while losses are shared in proportion to capital contribution. Imagine you and the bank jointly invest in a real estate development. You put in 40% of the capital. The bank puts in 60%. Losses will be shared in that exact ratio. That's only fair, right? But for profits, you might negotiate a different split, maybe because you're more actively involved in managing the project. There's also something called diminishing Musharakah, which is particularly popular for home financing. Here's how it works. You and the bank jointly purchase a house. You gradually buy out the bank's share over time. Each payment you make includes both rent for the bank's portion and a purchase of part of their equity. Eventually, you own the entire property. It's partnership with a clear path to full ownership. Trade and leasing models. The second category involves trade and leasing. And I'll be honest with you, these are the models Islamic banks use most frequently today. Some critics say these models aren't as idealistic as the partnership models, but they're practical. They work within Sharia principles, and they meet real-world needs. Murabaha is the big one here. Research shows that roughly 80% of Islamic banking transactions use Murabaha. So what is it? Let's say you need a car but don't have the cash. In a conventional bank, they'd give you a loan, you'd buy the car, and you'd pay back the loan with interest. In an Islamic bank, things work differently. You tell the bank exactly which car you want. The bank goes out and purchases that car with its own money from the dealer. Then, and this is the key part, the bank sells the car to you at cost plus a profit margin. You pay this amount in installments over time. The crucial difference? The bank isn't lending you money. It's selling you a tangible asset. The markup isn't interest. It's commercial profit. The bank takes ownership of the car before selling it to you, which means it bears the risk. If the car is damaged before delivery, that's the bank's problem, not yours. Now, critics argue that Murabaha looks an awful lot like interest-based lending in disguise. The defenders counter that there are real structural differences. There's genuine asset transfer, the bank bears ownership risk, and any late payment penalties go to charity, not to the bank's profits. Ijarah is Islamic leasing. The bank purchases an asset, a house, a car, machinery, and leases it to you. You pay rent. At the end of the lease term, you typically have the option to purchase the asset. For example, say you need factory equipment. The Islamic bank buys the equipment and leases it to you. You pay monthly rent. Because the equipment is registered in the bank's name, major repairs are the bank's responsibility, just like a regular lease. When the lease expires, you can purchase the equipment for a pre-agreed price, or sometimes a nominal fee. Then there are salam and istizna. These are forward transactions, but they're not speculative. Salam is commonly used in agriculture. The bank pays up front for products that haven't been produced yet. When harvest time comes, the farmer delivers the crops. This gives farmers cash flow when they need it most, and the bank profits from buying wholesale. Then there are salam and istisna. These are forward transactions, but they're not speculative. Istisna is typically used in construction. The bank finances the building of something that doesn't exist yet, say, an apartment complex. The customer pays in installments as construction progresses. Upon completion, the building is delivered. Now, you might be wondering, who decides whether all these transactions actually comply with Islamic principles? This is where something really important comes in. The Sharia Supervisory Board, sometimes called the Sharia Governance Committee. This board consists of independent scholars who are experts in Islamic law. An Islamic bank's Sharia board typically has at least 3 members, though most banks have 5 or 6. These members need to have deep knowledge in fiqh, especially fiqh al-muamalat, which is Islamic commercial jurisprudence. Ideally, they should also understand modern banking and finance. And crucially, they must be independent. So, what exactly does the Sharia board do? First, advisory work. When the bank wants to develop a new product, the Sharia board evaluates whether it complies with Islamic law. If it doesn't, they suggest modifications to make it compliant. Second, monitoring. All of the bank's current transactions, contracts, and practices are regularly reviewed. If something contravenes Sharia, they intervene immediately. Third, issuing fatwas, religious rulings. They have the authority to make judgments on Islamic legal matters, and these rulings are binding. The bank must comply. Fourth, reporting. In annual reports, the Sharia board publishes a statement on the bank's compliance with Islamic principles. This gives customers confidence that their money is being handled in accordance with their values. Now, I want to be transparent with you about something. Sharia boards face criticism too. Research has found that the busiest Sharia scholar served on 85 different institutions, and the top 20 scholars held 621 board positions combined. This raises questions about potential conflicts of interest. Additionally, these scholars command very high fees. Some can charge up to $500,000 for major transactions. Could this affect their independence? To address these concerns, some countries have established central Sharia boards. For instance, Indonesia's National Sharia Board sets standards for the entire country. Individual banks still have their own boards, but they must comply with national standards. It's an attempt to create consistency and reduce conflicts of interest. Islamic banking has evolved far beyond simple partnerships. Today, it's a sophisticated sector offering complex products. Let me walk you through some of the most interesting ones. Sukuk, Islamic bonds. Most people know Sukuk as Islamic bonds, but technically, that's not quite accurate. Why? Because conventional bonds are debt instruments that pay interest. Sukuk, on the other hand, represent ownership in assets. Here's how Sukuk work. Let's say a government wants to build a new airport. In the conventional system, it would issue bonds, borrow money, and pay it back with interest. In the Islamic system, the government creates a special purpose vehicle, basically a company set up just for this project. This entity issues Sukuk certificates that represent investment in the airport project. Investors buy these certificates and become partial owners of the airport. When the airport starts generating revenue from rent, commercial spaces, service fees, this income is distributed to Sukuk holders. The key is that Sukuk holders own a real asset. It's not lending, it's ownership. Sukuk come in different types. Ijarah Sukuk, lease-based. Murabaha Sukuk, sale-based. Musharakah Sukuk, partnership-based. And others. Takaful, Islamic insurance. Conventional insurance is problematic from an Islamic perspective for several reasons. It involves interest. Insurance companies invest premiums in interest-bearing bonds. It contains uncertainty. When and how much will be paid isn't clear. It resembles gambling. Gain depends on chance. Takaful offers a cooperative alternative. The word Takaful comes from Arabic, meaning solidarity or mutual guarantee. Here's how it works. Participants make contributions, not premiums, contributions, to a common fund. The purpose of this fund is to help members when they suffer a loss. The fund is invested in Shariah-compliant investments, Sukuk, Halal stocks, and so on. When a member suffers a loss, illness, accident, death, they receive compensation from this fund. If there's a surplus at year's end, it can be distributed among participants or retained in the fund. The Takaful operator, the company, manages the fund under either a Mudarabah or Wakalah model. In Mudarabah, the operator shares in profits. In Wakalah, they charge a fixed management fee. Islamic investment funds. Islamic investment funds invest in Shariah-compliant stocks and assets. But they can't just invest in any company. There's a two-stage screening process. First screen, sector. Companies in prohibited industries are excluded. Alcohol, gambling, pork, weapons, tobacco, and so on. Second screen, financial. The company's financial structure is examined. Criteria like interest-bearing debt ratio and interest-income ratio are evaluated. Typically, no more than 33% of the company's total assets should be interest-bearing debt. No more than 5% of its income should come from interest. The fund's performance is regularly reviewed by Sharia experts. If there's any income in the portfolio that doesn't comply, that amount goes through a process called purification. It's donated to charity. Islamic banking isn't perfect. It faces real challenges and legitimate criticisms. If we're going to have an honest conversation, we need to acknowledge these. First criticism: overuse of Murabaha. Remember when I said profit and loss sharing models? Mudarabah and Musharakah are the ideal of Islamic finance? Well, in reality, Islamic banks use fixed return models like Murabaha for the vast majority of their transactions. Why? Because it's lower risk, easier to manage, and profitability is more predictable. But this represents a departure from the spirit of Islamic finance. Second criticism: form over substance. Some argue that Islamic banking is just rebranding, calling interest profit, calling lending sale purchase, but remaining essentially the same. For instance, in Murabaha, the bank's profit margin is often determined based on market interest rates. This criticism has merit, though defenders argue that structural differences still matter. Third criticism: higher costs. Sharia supervision, two-stage structures, special contracts. All of these make Islamic banking more expensive to operate. These costs can be passed on to customers. Fourth criticism: lack of standardization. Different countries, different Sharia boards, different interpretations. A product accepted in Malaysia might be rejected in the Gulf countries. This fragmentation slows the sector's growth and creates confusion. Fifth criticism: guaranteed return problem. Some Islamic banks guarantee returns to customers in Musharakah or Mudarabah arrangements. But this contradicts a fundamental principle of Islamic finance: risk sharing. If profit is guaranteed, risk disappears, and it starts to look an awful lot like interest. These are real issues. I don't want to gloss over them. Islamic banking is a work in progress, and these challenges need to be addressed for the sector to fulfill its potential. Despite all these criticisms and challenges, Islamic finance has shown remarkable growth. The modern Islamic banking movement started in 1963 with Mitgamar Savings Bank in Egypt. Today, it's a global phenomenon. The establishment of the Islamic Development Bank in 1973 was a turning point. Throughout the 1970s and 80s, oil-rich Middle Eastern countries began establishing Islamic banks. In the 1990s, it spread to Asia, particularly Malaysia and Indonesia. From the 2000s onward, even Europe and America began opening Islamic finance windows. Today, the Islamic finance sector manages over $800 and billion in assets. This figure grows by an average of 10–15% annually. And it's not just Muslims who are interested. Many people and institutions looking for ethical investment are drawn to Islamic finance. Islamic banking is built on the real economy, on effort, on productivity, not on money making money. It rejects interest, seeks to share risk fairly, and requires that every transaction be backed by a tangible asset or service. Whether you're Muslim or not, Islamic banking offers you a different economic model. Maybe this model resonates with your values. Maybe it answers your search for ethical investment. Or maybe it simply helps you understand that our financial system can be structured in different ways. That the way we do finance now isn't the only way it can be done. And you know what? In a world grappling with economic inequality, financial crises, and questions about sustainability and ethics in finance, perhaps we need exactly this kind of alternative thinking. Perhaps we need systems that challenge us to think about money differently, to consider whether our financial tools serve real economic activity or just enrich the already wealthy. Thank you so much for spending this time with us today. I hope this has given you a clearer understanding of Islamic banking, its principles, its practices, its challenges, and its potential. If you want to learn more, I encourage you to read Sharia board reports from various banks, explore publications from AAOIFI and IFSB, or dive into academic resources specializing in Islamic finance. And as always, when making financial decisions, please do thorough research and consult with experts when needed. This is Islamic Finances, and we'll be back soon with more conversations about ethical finance, economic justice, and alternative ways of thinking about money. Until then, take care, and may your financial decisions align with your deepest values.